And welcome to today's segment of The Power of Money. I'm your host, Michelle Graves, and I welcome you to this particular show. It's an awesome show. I have a very special guest on with me, Randy Gallas, who is the president of Long-Term Care Insurance Agency with offices in Centerville, Ohio. They have a footprint in over 10 states as a general agency representing the needs of people exclusively in long-term care. So for those of you that have followed me over the years, you know how I am about specialists, which is don't go to a generalist when you need a specialist. And Mr. Gallas has been a specialist in this field for many, many years. Let me give you a little bit of his background and his credentials, so at least you'll know the caliber of the man that you're looking at. He's a modest person, but he's a native of Pennsylvania. He's spent 25 years in the Air Force and retired in 1996. He's been a financial planner for over a decade. He's been a certified specialist in long-term care for over 12 years. And for the last 8 years, he's been the president of LTC Long-Term Care Insurance Agency, located, correct me, in Kettering, Ohio. I had said Centerville. So why am I having him on today? Because in the month of November, they devote the entire month to educating the public on long-term care and destroying the myths, giving you information that will empower you to make decisions. We folks are in crisis mode, okay? I'm telling you for myself. I'm telling you we are in crisis mode because very few people are prepared for the realities of long-term care. Many of you right now are dealing with parents with Alzheimer, okay? That's a 20-year life and at $12,000 a month in a facility. Who's going to pay for that, okay? I can go on and on and on about long-term care. It does not involve going in a facility. You can get care at home. But if you have nothing, zero, because you have not handled your affairs properly, then the outlook is not good. I'm a positive person, so I bring on the best that I can get to come into this studio to share with us information to help you as you move into the holidays. This is the time to be looking at your parents and grandparents and yourself and saying to yourself, I need to make the necessary, take the necessary steps so that I do not find myself in a very, very uncomfortable and unacceptable environment. You control the outcome on this one. So without further ado, we're going to go on and get started in today's show. I welcome you to The Power of Money. Of course, I'm your host, Michelle Graves. Been doing this show for, I don't know, too many years. And I am now officially a senior myself, and I'm glad to be here. So where do we want to begin, Mr. Gallas?
Well, thank you, Michelle, for
You're
that
quite
introduction.
welcome.
I appreciate that. And season's
Awesome.
greetings to you, too.
Thank you
for
so
the holidays
much. I
coming
love
up
your
here.
red tie.
No, thank you. Yeah. Thank you.
Okay.
Well, yes, I think at best today, we kind of go over, where we've been and where we're headed in terms of long-term care. The awareness has been more prevalent, in the past year than it's been in the past 20 years, possibly.
That's exciting to me.
It is. The reason being is because of the demographics of that big population called the baby boomers, who are entering it into this, what we call this silver tsunami type of
It is definitely looking like a tsunami.
Yeah. So we have an agenda here. If we can take a look at the agenda, maybe we can kind of go through what we're going to cover today. We can do that. We're going to talk about basically what is long-term care. We'll talk about some of the challenges. We'll talk about the government's role. Of course, everybody wants to know, how the government fits into this equation. We'll talk a little bit about the market and then the Ohio Partnership Program, which is a plan that came into being 10 years ago.
10 years ago.
Exactly. And
so
then,
the state of Ohio got it.
In the state of Ohio. And we'll talk a little bit about that and how the other states have got together and worked together too on long-term care. And then, of course, a little bit about the future on long-term care re-envisioned. So if we could go to the slide, what exactly is long-term care?
Okay, let's move on further.
A couple more slides.
Okay. Oops. Just, okay. Keep going. Okay. There we go.
And one more slide.
One more slide. Yeah. Here we go.
So what exactly is long-term care? Well, basically, they're services designed to assist someone who's lost some or all of their capability to take care of themselves.
Okay.
And so when you look at that slide, you see like an illness. What could be a critical illness, obviously, something like cancer, or something like kidney disease, something like a stroke or something like that, where you would need care for an extended period of time.
Okay.
Additionally, what about an accident? I mean, long-term care, you could be in an automobile accident and need therapy for several months. And of course, the last one on the slide was the frailty of aging. Of course, at some point in time, we're all going to age. So
exactly.
It's going to happen. So therefore, you know, we may need to have some sort of long-term care services at that point. So, but a lot of times people seem to think that, well, geez, Randy, I mean, I'm not really old enough for long-term care. And it's like, it has nothing to do with that.
What do you mean?
It has nothing to do with age, because like we just mentioned, you can have an illness like Alzheimer's. I mean, that could happen as early as age 40 years old.
I'm seeing situations where that is real.
Exactly.
Right now.
Exactly.
Okay.
And same way with an accident. You could be in a car accident and need therapy for several months. And so a lot of times your insurance, your health insurance that you have, will not cover that extended care. So that's where the policy would come in and pay for some of those things.
Okay.
So it's not about being senior.
Well,
or
that's
being
a
old.
comfort, because a lot of people do make the assumption that it's a plan for people that are elderly, which is over 80, and I'm like, no.
No, that's true. So, and when you look at, there's a slide here that we have on the standard HIPAA definition. When you look at long-term care, there is a standardized definition for that if you had a policy, and that would be basically based on two things, a physical impairment or a cognitive impairment.
Okay, well, explain the difference.
Well, let's talk about the physical impairment. Things that we all did today, things like bathing, dressing, transferring, getting up and down, personal hygiene. We do that every day, but we don't think about it, you know. But when you can't perform 2 out of those 6 what we call activities of daily living, then basically you would have triggered a long-term care policy.
Okay.
Another thing on there was cognitive impairment.
Okay.
That's something like dementia, Parkinson's, Alzheimer's, or something like that. For example, my mom had Alzheimer's, and that would have been an automatic trigger for long-term care.
Okay.
She can still do all her activities of daily living. She just couldn't remember when she had breakfast.
Okay.
So, you know, so those are the 2 major triggers when you're talking about long-term care.
Okay.
Okay, so separate from any type of other type of insurance, like you get sick, you go to the doctor and things like that. It's not that. It deals mostly with these chronic type of illness situations.
Okay, so more recently we found out that Jesse Jackson has been diagnosed with Parkinson's disease.
Exactly.
And that's a progressive degenerative nerve disease?
It is, yes.
Okay, and there's no cure?
As far as we know, there's not. Just no, and I think there was another actor too. Hollywood actor, I can't think.
Yeah, he's doing pretty good. I know the guy that you're speaking about. He seems to be handling it.
So, but those are the sort of things that, you know, if you had a policy, then those would be like automatic triggers if you needed care or assistance.
Okay. Got it.
Let's talk a little bit about some of the facts. When you're looking at long-term care, there's basically about 13 million Americans today that are receiving some sort of long-term care.
13 million. That's
now,
a lot of people.
Now, that number's going to double in about 17 years to about 26 million. So when you mentioned earlier about we're facing some crisis here, we definitely are facing some crisis, because we have all these individuals that may be getting into a long-term care situation, and do we have the facilities, and how is it going to be paid for? So a lot of questions are going to be asked about these sort of things, but there's one key word that we need to do, and that's called planning. So we're going to talk a little bit more about that.
Okay,
in
that's important, because if the future says more people, and of course you see facilities springing up everywhere.
Absolutely.
I mean, it's just like the hedge funds in New York have just funded these things and they're exploding. But the challenge remains, it's expensive to stay in those facilities.
And you're right. You mentioned, I think once about some of the facilities costing as much as $12,000 a month.
Yes.
That's true. I mean, that is actually true. Most people don't believe that, but if you're in an Alzheimer's situation where you need care 24/7, around the clock attention, it can cost as much as $12,000 a month, and that's today. What about the future? What the cost is going to be? So, and then we also talked about the baby boomer situation, about that generation turning 65 every day. That started back in 2011.
Yeah.
Okay, so that's a huge demographic amount of individuals, kind of close to the millennials, because the millennials are kind of close to that too. But it's a big generation, but that generation is aging, and that generation is going to be looking for
and they're
solutions.
opting out, which I'm just going to tell you, I was not aware, of how many of my peers are opting out. And I mean, we all came out of high school, college together, had our families, and here we are.
Here we are.
Yeah.
It happened just overnight.
I can't even believe it. I still find it like pinch myself.
Here we are.
It's unbelievable.
Well, let's talk a little about some of these challenges.
Okay.
Okay. Again, we mentioned about the aging baby boomer population, 80 million. That's a huge group of individuals. How is I mean, there's so many questions you have to ask yourself. How is the government going to handle that? How are we as a nation going to handle that? I mean, there's so many the questions that we're having there, and that the government says that 70% of us over the age of 65 will experience some sort of level of care in the future. We don't know what that is. It may be home care, it may be just intermediate type of care, but again, that's a big number.
That's a big number.
70%. Yeah.
Yes.
So again, you're just handling the risk factor here, and that's what we're trying to talk about. The other thing is being prepared. Most of us are unprepared for the consequences. I'll tell you that right now. Who is going to provide this care? Where is that care going to be provided? What level of care is that going to be? And more important, how is that care going to be paid for?
Right. Where is the money coming from?
Exactly. So that is a huge consequence there that we should be thinking about that. And over the holidays, like you mentioned, is a good time to bring these sort of things up.
Yeah.
About planning.
Right.
You know.
Well, I know that not to interrupt, but I do know that with our parents, the assumption is that we are going to take care of them, that they don't have to concern themselves with that because they can move in with one of us or families, and some families are coping with it, but a lot of families are not coping with it.
That's true.
That's tough.
You have a family situation where you have mom and dad, and you have your own family with your children, and so trying to be a caregiver, take care of mom and dad, or take care of the kids. I mean, it becomes it's a problem. It creates a lot of stress and a lot of strain, and it can really affect you, in many different ways. The other thing is about the government. There are no government solutions to long-term care.
There are no government solutions.
We have not found one. Congress has really basically stalled on what to do about this generation, because they know, when you look at, yes, everybody says, well, Medicare and Medicaid and all that, those programs are there, but they're there for the indigent. Those are welfare programs, okay? They're not meant to be paying for your long-term care.
Right.
So basically, there is some struggles and things going on, and different studies going on, and how do we handle this aging population? So it's a problem.
Wow. And there's no government solution. So that means that it's on us.
We are the burden of that responsibility.
We are the burden. I'm okay with that, though.
We are the burden.
I'm okay with that.
That's a good way to put it.
I mean, I am.
And then, of course, the cost of extended care is also creating that financial burden. Hey, look, we've spent how many years, building up our assets and things like that. 30 years, 40 years, or whatever it is.
Yep, your working life.
We're working, and then we have all that. So why would we want to then, say, hey, look, now we're going to take that money and give it back or put it into a nursing care facility and liquidate or spend down? Why would we do that? We wouldn't. So we wouldn't do something like that. So basically, we have to, again, be prepared for those consequences and do some planning.
I think you bring up an important point, because one of the things that I've shared with people since I was introduced to long-term care many years ago is, what is the point in me helping you accumulate sizable assets what is the point when you get sick at 76 and have to go into a facility, or you stay at home for full-time care and you watch everything that you've accumulated? I'm talking about real life situations. Randy, my very dear friend, her father had Parkinson's, and he was a very affluent in the day, very successful businessman, had portfolio, and when he finally died, and it was there when I say he was going to have to go into Medicaid.
Okay. Yeah.
Devastating.
It is.
Very devastating.
When that happens, you lose control. You have no control over your level of care at that point in time. So, and then the cost of care. Let's talk about that. The chart that we just had up there, it's kind of staggering if you look at that. This is in Ohio. Every state, of course, is different. If you were in the state of Alaska, just to think about the cost of care in Alaska is $650 a day. So if you needed care in the state of Alaska, I mean, that's kind of huge. I mean, of course, we're nowhere near that here in Ohio, but I mean, that cost of care, and again, it's going to continue to go up in the future. So if you looked at that $100,000 a year, that's quite a significant amount of money to pay out of your pocket.
Yeah.
And of course,
Is
across
that just basic minimum standard expenses?
That's a private room, and that's an average cost, obviously. And that's somewhere in the neighborhood of $280 a day. If you get a semi-private room, it's about $230 some dollars a day. And then, of course, you do have assisted living, like we show in the slide. Assisted living is a little bit less, where you can still do some of your activities, but you still may need some help or assistance. You don't need 24/7 supervision. So assisted living is, and that's what the baby boomers are asking for. Facilities and campus. Some actually call it a campus because you can kind of move from one area to another area depending upon your situation and your level of care. So.
But you know what? Is that where we are? You have to go into a facility?
No. No, actually, to be quite honest, from all the claims data that we see, actually about 80% of all the claims, people are receiving their care where? At home.
Wonderful.
And we love that, because that way when we design a plan, we don't have to design a plan for $12,000 a month. We can design a plan much lower than that would cover home care. And home care is somewhere in the neighborhood, if you needed care, it'd be like $100 a day maybe. If you had a nurse come in, or if you had an aide come in, or a homemaker come in, you're looking at like $20 an hour or something like that. So if they were there for 4 or 5 hours a day, that would be about $80 to $100 a day. That's about $3,000 a month plan. Versus a 10 or, you know, so we don't design plans to that size because we want to make it affordable for everyone. And so if you look at the statistics show that about 80% of the care is being in a home environment. Wow. I like that. I personally
think that's great.
Would love to have that.
Right. I don't think people like being in an institution.
Exactly. And then a cost of care, when you look at it down the road here from the cost of care, from the bigger picture, again, if that cost of care today, like we mentioned, is around $280 to $300 a day, and you needed care, and they say the average amount of time needing care is about 2.5 to 3 years. Then you would be spending about $300,000, you know, for that care. So if you had $300,000, your financial planner may say, Michelle, you can't spend that. That's your long-term care. You'll have to set that aside.
Right, if you're going to self-insure.
If you're going to self-insure.
Yeah, that's too much.
So basically, but as you can see from that data, basically you could have basically $1 million problem, especially if you did have Alzheimer's and it lasted, you know, 4 or 5 or 8 years. So it just depends on what the cost of care is and for how long you need it. But once again, by having some sort of protection, you can protect some of the assets that you've built up by using leveraging, you know. So
even if, and just tell me based on the data, do wealthy people have long-term care?
I'm glad you asked that question.
Because, you know, I'm just saying to you, they have the assets.
I'm glad you asked that question. I have several individuals that are quite wealthy, 7 figures, okay, or more, and they actually have long-term care. Could they self-insure? Absolutely. Would they self-insure? No.
No.
The reason being is because they're paying a small amount of premium to leverage a large amount of long-term care coverage if and when they ever need it. So basically, they have other plans, and again, there's that word again, they have other plans for that money, whether it's legacy or grandchildren or whatever, you know, just different foundations and things that they want to put it in. So we're seeing a lot of them, you know, hey, we're not going to spend our money that we've earned over these years for a long-term care. We'll put that risk on the insurance company.
That is a very powerful statement. We'll put, viewers, did you catch that? We'll put the risk on the insurance company, which is where it should be anyway. That's what insurance companies do, correct?
Yes, it is for your home, it is for your car.
Yeah, so why not do that with that venue?
Exactly. So yeah, we do have wealthy individuals that do long-term care.
Okay.
Just for that reason, to leverage money and put that risk with the carriers.
Got it, got it. Makes good sense to me.
So kind of gives you a flavor and idea of what that cost of care can be. And it's a little scary. I mean, that's what it is today. But in 10, 20, or 30 years, those numbers will even be much larger than that that we're talking about today. In fact, I've actually seen those numbers. When I started in the business about 12, 15 years ago, I mean, the nursing home cost skilled care for a private room was somewhere around a neighborhood of $180 to $200 a day. Now we're at $300 a day. So you can see those numbers are increasing. So.
And will continue to increase because of demand.
Because of demand, exactly.
Yeah.
So let's switch a little bit to the government. See
Okay.
how the government's,
what's the government's
what the government has to say about this. So first of all, on the next slide, there's a thing I want to mention about Medicare awareness. Contrary to what you've heard from your neighbors or friends, Medicare does not pay for long-term care.
That needs to be said loud. Medicare does not pay for long-term care. I hear that all the time from seniors. I'm not kidding you, and I'm one now, but I'm like, where did that come from?
I'm not sure. I just got a letter from, in fact, some I don't know how they send that out, but the state of Ohio does send out little notices every once in a while about getting long-term care.
Do they?
Absolutely. In fact, I got one of those letters right here. And it basically says, in the first paragraph, Medicare does not pay for long-term care. You should look for long-term care insurance. The state of Ohio is telling you that.
The state of Ohio.
Exactly.
My goodness gracious.
Yeah.
I'm glad they're doing it.
They should do that.
They should do it so that people can have a moment, smack, a moment.
Well, there's a reason. I mean, every state, obviously, and we'll talk a little bit about the partnership program that's taken place and swept the nation here, but every state that has that responsibility, because basically, if you don't take responsibility for your health care, long-term care, and have a policy or something, then the state is on the hook. In a way.
Well, yeah, with Medicaid.
With Medicaid, they're on the hook.
Yeah.
And of course, we know that's
now, viewers, Medicaid is not Medicare.
Correct.
Okay, two different programs. Okay.
Right. So we'll talk a little bit about Medicaid and how that, you know, intertwines into with the long-term care. Okay. So the next slide, misconceptions or whatever of payment options. Look. If you went out and surveyed most people and you asked them about, you know, long-term care, who's going to pay for it? Again, the number one response is going to be Medicare. Like the slide shows, about almost 50% say that Medicare is going to pay for long-term care.
That's sorrowful.
And then there may be 60% say, well, I'm going to use my Social Security check to pay for my long-term care. Well, I don't know, Michelle, but if you look at those Social Security checks, they're not that big. And number one, who knows if they're even going to be there in the future?
I'm looking funny because I don't know. I don't know.
So, and in fact, the Social Security check does actually dovetail nicely into some of the plans that we designed, because then you don't really maybe have to have a huge benefit plan. You could maybe supplement that with your Social Security check if you needed to.
Right.
If you needed to.
Right.
And then, of course, the last thing was like about 70% of individuals still feel that the Affordable Care Act is paying for their long-term care.
You're kidding me.
I mean, again,
that's disturbing.
It's very disturbing.
That's very disturbing. That's a setup.
Well,
I mean, it looks like it, a misinformation and miseducation.
right.
Which actually presents an opportunity.
Presents an opportunity.
It does.
Right.
Okay.
So again, the public and the viewership needs to understand that the programs like Medicare don't pay. Social Security, I mean, that check is only going to be $1,000 to maybe $3,000. I'm not sure, you know, somewhere in there, but not enough to cover your care.
Right,
okay?
right.
Because the check was not even designed, you know, to take care of those sort of things. And then, of course, the Affordable Care Act. So let's take a little bit of a journey here on looking at the differences between Medicare and Medicaid. Medicare, again, like we mentioned, is a program that's basically short term. It's only for like 100 days. Okay. So if you're over 65, you enroll for Medicare, you need assistance from your doctor or whatever, it's going to pay for that. Hospitalization will pay for that up to a certain number of days. Okay. Usually it's 20 days is where they pay for it at 100%.
Right.
And then you would purchase what they call a Medicare supplement that maybe pick up the other 80 days.
Okay.
But once that day 100 rolls around,
you're done.
You're done and you're on your own.
And I will say that you must show progress. At least it's my understanding.
That's true.
You must show progress for them to pay.
To continue to pay.
Right.
Exactly.
Or else they won't.
Exactly. And then if you look at Medicaid, again, a little bit different, but now to get to Medicaid, everybody will say, well, you know, the government's going to pay for my care. But they don't know that you have to spend down your estate.
Everything you have.
Everything you have. If you're a single person, that's $2,000.
Okay.
Okay. If you're a married couple, they'll leave you keep $120,900, and that's adjusted every year.
Okay.
It has been going up a little bit, so probably in 2018 it'll be a little bit higher than that.
Okay.
And then, of course, there is a thing called a look-back period where in the past, you could transfer assets while the government doesn't want you doing that, obviously.
No,
so,
because that takes away from them.
Exactly, exactly. So there used to be a 3-year, now it's a 5-year, and there's even discussion that they're going to, in some countries, have 10-year look-backs.
Well, that's what I understand, that we're heading in that direction.
In that direction.
And really, I've heard that oftentimes said, which is, oh, I'm just going to transfer everything to my children. And I tell them, oh, I don't think you want to do that because you're going to be disqualified.
That could be dangerous.
That can be dangerous.
That could be. If you went into a situation, they may ask for that money back.
Oh, they probably will.
Right.
Based upon what we call an illegal transfer.
Exactly.
Right?
Right.
Yeah.
So, and then there's a chart here that I call about eligibility for Medicaid. We'll take a look at that real quick. There's things called countable assets and there's things called excluded assets.
Okay.
When that caseworker sits down at your table, they're going to say, you're going to have to liquidate these things. Your CDs, your stocks, your bonds, your IRAs, annuities, your vacation home, you'll have to sell that. Life insurance, if you had life insurance with cash values greater than $1,500. And again, that's a shock to a lot of people. We've seen it happen. Clients have come in and say, we didn't know that. We didn't know that we had to liquidate our estate. We didn't know that mom and dad had to, cash in all their CDs, and so it's to get on Medicaid, that's what you have to do. That's the rules. And of course, there are some things that are excluded, and that is like your home. You get to keep one motor vehicle. I remember I had one gentleman come in and he said he had 7 cars, and I said, you better sell 6 of them. So, so.
Oh my God. Now be clear about the home, because that's kind of tricky.
It is.
The home.
It's a little tricky.
Okay, for a single person that goes into a facility and they have a home, that home has to be liquidated.
Well, there are some rules to that where they've come up with some rules. That used to be a one year. Yeah, I think they've actually made some changes to that ruling, and I think it's like 6 months now. But I can't quote me on that. But I'm thinking it's like 6 months. But it used to be a year. Yeah, but after that year, you'd have to sell the property. Exactly.
With couples, however, the spouse that doesn't go in does have the right to stay in the home.
The surviving spouse,
that
spouse can stay there in the
until
home
he or she goes into a facility or dies.
Exactly.
And then the state has a claim.
It's called Medicaid estate recovery.
Oh, gosh.
So you're
They
not
even
getting
have
out.
a name for it.
There's a name
Randy.
for it, yeah. So you're not getting out free. Yeah. So anyway, but I didn't want to get into the big discussion about Medicare and Medicaid, but I think the viewership should know that there are rules and things,
Right.
like in terms of assets, because a lot of people think that, geez, I get to keep my IRA. No, you
No,
have to
you don't.
liquidate that IRA. And the bad news about that is liquidating an IRA, well, what if the market, I mean, I know we're going through unprecedented times right now with the market.
Yeah.
But what if in the future that market starts going south again and you needed a long-term care and you'd have to liquidate that IRA, you may, be in a financial situation there by doing that.
Right.
And not only that, you have to pay taxes on that money.
Right.
So again, that word, doing some planning, early planning, would prevent you from these things happening.
But I think this is so powerful because the amount of misinformation that is out here today, as well as miseducation, because the most vulnerable group doesn't know how it plays out. I'm serious. I don't think there's any human being who is moving into that category of senior or elderly that's prepared for the psychological blow.
Yeah.
I mean, really, to see everything puff of smoke. Yeah.
Everything you've
I mean,
worked so hard for.
Right.
Yeah.
Everything you work so hard for, looking at your grandchildren and all the things that are now before you, and puff. Poof. Huh.
Yeah. So I think that's a nice segue into the next thing called what I call the power of long-term care planning.
Okay.
So we're going to kind of move into that, well, Randy, give us some solutions and give us some ideas of how we're going to overcome these challenges that we may face or these planning obstacles. So on the next slide, it talks about the spectrum of long-term care solutions. They range all the way, and we talked a little bit about it from the left, which is self-funding. Yeah, if you're a millionaire, maybe you could self-fund. You could. But we have some wealthy individuals that don't do that. So, and you can go all the way around to the right, which is traditional, standalone, long-term care insurance policies. Now, in the middle there, you see a thing called hybrid solutions. They've been around, but they're now more prevalent than they've been 5-10 years ago.
Okay.
Where you're using different products to leverage for long-term care.
Okay.
Meaning that you can take money and reposition it or take money and invest that, and it's providing a leveraging factor of anywhere from 2.5 to maybe 4 times to get long-term care coverage. And it's all guaranteed.
Okay.
So those programs are starting to become more popular today. Right. So, but that's kind of the spectrum of long-term care when you're looking at different options that are out there. We'll kind of go into a little bit each one of those as we go through the discussion here. So, but one of the things before we get into that, the state of Ohio has actually put together what they call a partnership program. And again, we talked about that. It started 10 years ago. In September of 2007, Governor Strickland put that in law, and that all came from a law that was basically structured from a thing called the Deficit Reduction Act of 2005. I know, everybody says, Randy, we never heard of that before.
Right.
It's like, where did this come from? So that's again, the education process here, allowing us to come on here to the viewership and explain some of these things, because that program that was signed by all governors basically opens up long-term care to all 50 states. And it's called a partnership program. And what it was designed to do was basically reduce that amount of money that would be paid out through those programs called Medicaid. Okay. So by having your own long-term care policy, you're actually reducing the state's burden, and actually, guess what? Maybe even reducing some of the burden on taxpayers in these states. By doing what? By taking responsibility.
Okay. So what are the benefits to the consumer for being involved with this partnership?
Let's talk a little bit about that. The qualifications for partnership, let me first of all say that there's no cost for that partnership program. It is built into the insurance company's policies.
Okay.
So if a company regardless, I don't know, doesn't make any difference whether it was John Hancock or Transamerica or whatever, the Mutual of Omaha. Those policies are all partnership policies.
Okay.
And meaning that in the back of that policy, there'll be a special section back there talking about the Ohio partnership.
Okay.
And so the only qualifications are basically you just have to be a resident of your state. In this case, a resident of Ohio, and you have to have what they call some inflation built into it. Well, of course, we'd want to do that anyway because the cost of care goes up in the future.
Right.
So by putting inflation protection in there, and depending upon what age you are, you can basically see what type of protection, level of protection you would need. And then, of course, that plan has to be tax qualified. Tax qualified meaning that when you use the benefits of that plan, there's no taxes on that money that's coming out. So it's a tax qualified plan. Right. That's why I put the little thing up there. There's no taxes. So
no taxes.
Correct.
Okay.
And even the better news is you can deduct the premium for your long-term care policy on your Ohio state income tax.
Nice.
Federally, it seems like a no-brainer.
Right.
Why the federal government doesn't say if you bought a long-term care policy, you can deduct that off of your taxes. In some cases you can, but you have to hit a certain threshold of money in order to get that deduction. But if they made a carte blanche type of, saying, hey, everybody can take that premium, that would maybe boost the sales and have more people do that.
I think it would.
Exactly. But that's what the partnership programs do. And then the next slide basically shows all the different states. Now, all those green states are partnership states. They've all been approved. There's some gray ones that still have not gotten into it yet because there's some things that they have to do because it is linked into basically Medicaid. So, and then the red states eventually will turn green. And I think, doing this production, that New Mexico has become partnership. So we can color that in green. So there's only probably about 4 or 5 states that yet don't have the partnership program. But if you buy your plan in Ohio, you can use it in any state. And
really? It is portable?
Yes. So people say, well, if I buy this in Ohio, can I use it in Colorado? Absolutely.
Yes. Okay.
And same way, and Colorado would accept your partnership.
Okay.
Meaning it's the same rules that Ohio set up, be the same rules they would honor those rules.
Okay.
It is very good.
That's very good because people are mobile today.
Exactly. And another thing too, basically when it comes to long-term care, sometimes some individuals say, well, we want to move maybe to, out of the United States. What if we move to a different country like London or Germany or Hong Kong? I had a lady that's moving to Hong Kong because her children are there.
Okay.
Your policy is also good there. It goes with you.
Oh, that's excellent.
So they all have international coverage built into them.
Okay. That's a no-brainer. You would think that the states would be promoting that aggressively. But Ohio, you said, sent a letter.
They've been sending letters out, yes.
I'm telling you, that's phenomenal.
Just received it like a week ago.
That is phenomenal.
Like, did you do your long-term care yet? And it's like, I've already done mine.
Right.
But it was interesting they sent that out. And here's, you can send off for a little brochure.
Scary.
Yeah.
That's wonderful.
It is. So hopefully we'll see more and more of that.
Yes.
And I think maybe now the states, they did have a big campaign when Ohio became partnership back in 2007. They actually had trifolds and campaigns and went around the state and gave presentations, and of course budgetary reasons why we haven't seen that as much, but now it looks like we're starting to see an uptick in that movement again, which is good for the
I do know that statistically a large part of the budget for the state of Ohio is paying for Medicaid.
It is.
For seniors. Not
seniors.
Medicaid for children, it's Medicaid for seniors. And that can't continue.
No, it cannot.
No,
cannot.
No.
So that's basically the partnership.
Okay.
So it's a good, there's no cost for partnership, it's built into the plan, and basically we handle all of those different carriers that handle
Now
that.
the benefit of that partnership is that if you do have to go into a facility, assets are protected.
Very good. I'm glad you brought that up. That's a very important point. Exactly. So if your policy at the time you went on claim was, say, like $200,000, you would get to protect $200,000 of your assets.
That's significant.
And would not have to go through the quote-unquote spend-down scenario.
Okay. So you're protected. And is the partnership program offered through a number of carriers, or is it a group that's approved? How does?
It's a number of carriers. Most of the major carriers have the partnership program.
Okay.
Like I mentioned, Mutual of Omaha, John Hancock, Transamerica. They're all partnership.
Okay.
Partnership programs.
Okay. Good.
Right.
Good.
So that's basically a little bit about the partnership, and if you more information on that, we can do that.
Okay.
So,
Okay.
Yeah. A typical policy, sometimes a client asks, well, how does this policy work? They're very simple. Basically, what you're doing is you're purchasing what they call a benefit bank. So
Okay.
basically, you put your premium in. It's from day one. It's not like you have to wait 5 years for this to happen. So you pay your premium, whatever that is, whether it's $100 a month or whatever, it doesn't matter. From day one, you have coverage.
Okay.
So in this case, that little funnel there basically shows that all that money is there, and you can take it out either on a daily basis
Okay.
or a monthly basis. And the triggers to that policy are basically bathing, dressing, like we talked about, 2 out of
got
6
it.
activities. And on the right-hand side is all the different things and more that they cover.
Okay.
Whether that's home
Okay.
care, assisted living, skilled care, rehab care, Meals on Wheels, things like that.
Yeah.
Home modifications. A lot of people don't even know that, really, if you need a ramp or if you need grab bar rails put into the bathroom.
That's also a part
that's all
of that?
part of the plan.
See, that to me is significant, so that you don't have any out-of-pocket yourself.
You're right.
To retrofit your home for what you're going through.
Exactly. Exactly. So
Okay.
that pays for all those things. As well as hospice care. I mean, I know a lot of people say, well, the state pays for that. But again, remember, it's all budgetary. So again, your policy would pay for that.
Okay.
And hospice care at home, it would pay for that care
Oh,
at home,
really?
too. Exactly.
Okay.
Yeah. So we talked a little bit about the long-term care, like different solutions there in long-term care. Let's talk a little about what I call the great expansion. Over the past 2 or 3 years, we've seen a number of plans come out, and they're not long-term care plans, but they're short-term care plans. So Michelle, if you came to me and you had some situation where it was a critical illness that you couldn't get a long-term care plan for, you would qualify for what they call a short-term care plan.
Okay.
It's for home care only, but that's okay because it would pay for like up to a year's worth of coverage. Okay. So basically, they're very affordable, and there's no health questions.
Oh, really?
As long as you're not in an assisted living or a nursing
Right
home.
now.
Right now, as long as you're not in that, you're in a home care environment and you're getting care at home, you can purchase one of these short-term care
wow.
plans. And let me tell you, the cost of these plans are extremely affordable, okay? And the other thing there was critical care policies. Critical care policies basically cover a little bit more than the short-term care plans, and you can get like 2 or 3 years out of them, but they also cover home care, assisted living, and skilled care.
Oh,
Now,
really?
the
Okay.
only difference between that and a traditional plan is they don't cover everything.
Okay.
However, they do cover the 3 major areas, and they would be heart, cancer, and Alzheimer's.
Okay. And that's
80% of the
that's
claims.
80% of the
That's
claims.
80% of the claims.
I mean,
So even if you had difficulty with a traditional plan, we could get you a plan under the critical care. And again, those are very affordable, and they are all cash benefit plans as well.
now what do you mean when you say cash benefit?
You're going to
plan?
get a check.
Oh, you don't file a claim, you get a check.
You get a check. If your benefit is $2,000 a month, they're going to send you a check for $2,000 a month. And you do not need to satisfy the 2 out of 6 activities of daily living. It's just by a doctor saying that you need this care.
And you get a check.
And you get the check.
Oh my
So-
goodness.
So
Bingo.
these are all new things that are
that I
entering-
didn't even know about that.
all new things entering the marketplace.
Oh my goodness.
Right.
Yeah.
So very helpful. And then, of course, the hybrid or linked benefits. We talked a little bit about the hybrid or linked benefit plans. Basically, there is where you're taking, and in this case, money that you might have had in a CD that's getting what? Nothing right
nothing.
now. Is sitting there. And if you said, well, I'm using that CD for my long-term care event, well, why not take that CD, regardless of what it is, if it's $50,000 or whatever, sitting there for long-term care, and you can leverage that and get $150,000 of long-term care coverage. Why wouldn't you do that?
Why wouldn't you do? Because you don't know.
You don't know. That's
You
exactly
don't
right.
know.
You don't know.
I mean, I just don't believe people do these things because they're dumb. They just don't know.
So that's what we're trying to do, educate.
Okay,
I mean, the
okay.
key to long-term care a lot of times is just education. So hopefully the viewership will see this and see some of these solutions out there where
Right.
a situation, well, they may have gone to another insurance individual agent and said, well, you don't qualify for long-term care, but that agent may not have all the tools necessary to say, well, hey, what about a critical care policy? Hey, what about a short-term care policy?
Right.
We handle all those and broker all those different plans.
So let me ask you how, because the long-term care insurance industry did go through a transition. It did. Genworth and John Hancock, there were some people that bowed out.
Yeah.
Has that stabilized? Because the concern I have expressed is, are rates going to continue to ratchet up when I get into this?
We hope not. We're starting to see, and again, remember, the insurance companies, they can't take your premium dollars that you send in and invest it in the stock market. They're prohibited from doing that. So they have to put it in fixed instruments, whether it's T-bills, treasury notes, things that are paying not 5 and 8 and 10%. They're only paying 3, maybe 4%.
Right.
So that's one of the reasons why we have some issues. As the interest rate environment goes back up, I think we're going to see that the premiums and things stabilize and be a lot more constant.
Well, I think that's good, and I do believe, as you do as well, that the rate environment is going to change because savers have suffered. Insurance companies such as this have suffered.
Exactly.
How do you invest their money?
Right.
So that you can guarantee the rates.
Yeah, well, all the insurance carriers have what they call reserves. So there's reserves to cover every policyholder that's out there.
Got it.
There's only been one carrier that went through a problem, and that was called Penn Treaty, and that company was basically one of the earlier pioneers in long-term care, and they did go into what they call receivership, but basically even the consumer is protected, even if a company does run into financial problems.
Yes.
Under what they call the Ohio Guarantee Association, your policy is protected up to $300,000.
Oh, well, that's nice.
So you not only have a long-term care policy, you have another policy built on top of that the state of Ohio protects.
Nice.
So
nice.
So we don't.
Well, would you mind,
Sure.
for the benefit of my viewers, giving them how they can reach you?
Yeah, we can do that. But I did have, I think, 1 or 2 more charts in here that we might want to just take a look at real quick.
Okay, that'll be fine.
We'll take a look at, we'll see if they can put those up on the screen. It's like a block diagram chart that kind of shows how a policy works.
Okay.
Yeah. Yeah.
Okay.
It's basically just shows remember we talked about, we don't need a big $5,000 or $6,000 or $10,000 a month benefit. Here, we just did a $3,000 a month benefit, a 3-year plan with some compound inflation on there. And you can basically see how that plan will grow at the bottom. But you start out with $100 and some thousand, and then that policy grows over time. And so basically that's how it works. So that one page is a long-term care policy.
That's
pretty simple.
That's simple.
Yeah.
How expensive?
That particular plan right there was for a 60-year-old couple. I think it was like $2,900 a year or something like that.
Oh my
now,
goodness.
If you don't put inflation protection in there and you wanted just to have that $3,000 a month benefit, remember when I talked about how the Social Security check might help you out? You could take that 3 plus you add your $2,000 of Social Security. You'd have a $5,000 a month available. And then that plan would cost you $1,500 a year for both husband and wife. So about
and
$700.
I don't think people know that.
That's $700 a person.
That is absolutely.
For 60 years old.
Yes.
It's extremely affordable. Extremely affordable. And there's solutions and ways you can to make it work for you and for every household.
Okay.
Sure.
Okay.
And I don't know if there was another chart up there we had or not, but I did have a chart up there on the short-term care plans. They're even more affordable when you look at the short-term care plans. I think I had Fred and Wilma Flintstone. They came in and they were looking for a short-term care plan. They were age 70. And basically, you can see what their plan would be for a $54,000 benefit that pays out $150 a day for 1 year, was what that number says, $36 a month.
$36 a month.
Michelle.
Come on.
Michelle.
Come on.
Who wouldn't do that?
Who wouldn't do? But I'm telling you again, lack of information or miseducation. They don't know. But you know what, viewers? Now you do. And even if you don't know, you have a contact person that I endorse. I mean, I work with this man with my clients. I'm just telling you. It's amazing. It's amazing what happens when you're dealing with professionals that know their trade and know how this has to work. You have no excuse. What's the ideal age to start thinking about this?
Well, you know, everyone's different, but you know, typically right around 55 years old, where the kids are mostly out of the house, and you know, and so you don't have that. Hopefully, the college educations may be paid for. So between 55 and 60, we see a lot of traffic
People
there.
moving on.
Exactly, but that doesn't mean we haven't seen a lot of 65 to 75-year-olds either. We're starting to see quite a few of those.
Good.
So
Now,
just
is
good
there
too.
an age where it is not suitable as you age?
Well, I
Like
mean,
if a person is 84.
you can still buy a short-term care plan.
Oh my goodness.
It's up to age 85.
Up to age 85.
Right. Exactly.
Wow.
So yeah, and I do have some information, contact information there. if
Okay,
can
would you
show
please?
that.
'Cause
Sure, you
time
can
is-
put that up on the
Yeah.
screen. And
Okay. We'll go on and for the benefit of those that don't want to read, why don't you just tell them how to call you?
Sure. Well, we can be reached at 937-294-1415.
And say that again, please.
And that's 937-294-1415.
And what is your email?
And email address is ours and Randy Gallas, Gallas, at ltcinsuranceagency.com.
And of course, for those of you that don't want to do that, just Google his name
There you go. Right there is up there.
and long-term care, and you will get a phone number.
Yep.
And I encourage you to make those decisions. It's never easy, but the first step begins with your willingness to do it, to know that the statistics are not in your favor. All you have to do is go and see for yourself what happens when people are ejected. There's a very large facility in Cincinnati that does rehab work, and the people are not going to get any Medicare payments, and their families have to come and get them.
Right.
They have to come and get them. If you don't, I don't want to give their name, but trust me, the facility is on Galbraith Road in Cincinnati. And all these people are in the front of the building in wheelchairs, waiting for their families to pick them up because they don't have any solutions to their situation. And it goes back to what I said in an earlier show. We are in a time in history that I don't even know where things are going, but I do know that self-awareness is where it begins. And that is coming out of denial, coming out of, I can't believe I got this old. All those things that go along with the baby boomer. Oh no, we were doing hot pants and Pepsi, but this is real. This is real. It's looking at you in the face. And so I'm going to give Randy's phone number again. For those of you that didn't get a pencil and paper, get a pencil and paper out now and write the number again. Randy Gallas, 937-294-1415. That's 937-294-1415. For many of you that want to do email, you can contact him at rgallas, no space, at ltcinsuranceagency.com. This was a great show.
Thank you,
I
Michelle.
appreciate
Thank
your
you for
time.
inviting me. I appreciate it.
I just felt so strongly that as we move into 2018, things need to be put in order because the alternatives today are just not good. And yet there's tremendous opportunity and tremendous hope for those of you that are willing to take just take it the way it is, get good professional help, and get it done. I'm Michelle Graves, and thank you so much for being a part of today's segment of The Power of Money. We're looking at long-term care insurance and where it fits in your planning. I appreciate you listening in. Wish you great holiday, great family time, and as always, God bless you. Goodbye.